Good afternoon, and welcome to another program brought to you by the Black Business Professional Association, the BBPA, which continually seeks to support our community and our businesses. I'm your host, Anton James. I'm a marketing strategy consultant and an event host and moderator. This program is the BBPA's Level Up program, a finance and funding masterclass for Black led businesses. We are in the fifth of 13 weeks, 13 programs spanning from January 19th to April 13th. Today's program will be focusing on financial reporting requirements and managing your taxation. For today's session, I would like to introduce Michael Case, Principal and Director of MAC Professional Corp. But before we jump right into those things and, and have you meet our special guest, I'd like to cover a few critical issues. And the first one I'm going to cover is our land acknowledgement. The Black Business Professional Association acknowledges that we are on the traditional territory of many nations, including the Mississauga of the Credit, the Onondaga, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis people. The BBPA also acknowledges that Toronto is covered by Treaty 13, signed with the Mississaugas of the Credit, and the Williams Treaty, signed by multiple Mississauga and Chippewa bands. The next thing we've got to cover is the BBPA's legal disclaimer. So, to be clear, the ideas and strategies discussed in this program are general in nature and should not be considered advice specific to any individual. They are designed to communicate basic information to help participants understand the basics of the topics presented. The materials neither purport nor intends to give any financial, legal, or tax advice or earnings expectation. Nothing in this program should be considered investment or financial advice. For financial, legal, or other advice, you should seek the advice from your own trusted, independent financial or legal advisor, or consult with a qualified advisor prior to acting with regards to ideas presented in this program. The opinions rendered in this program are those of the presenter and does not necessarily represent those of the BBPA, RBC, HSBC, the Donald Reed Estate, or any of other our sponsors. With that, I thank you for coming and bringing to the stage and bringing greetings on behalf of the BBPA. I would like to introduce the president of the BBPA, Miss Nadine Spencer. Nadine, are you there? Well, we might be having a few technical issues, but that's quite okay. Giving you some background on this program itself. This program is decided, the Level Up program is actually decided for the Black businesses. And what it is to give them a full end to end from concept to delivery, what a Black business should do. So the first thing we did, the first few weeks, we assessed the marketplace. We talked to the head of the HSBC Bank, the head economist. Then we talked to the Deputy General of the Bank of Canada to understand what is the economy going to look like? Where's it time to roll out? Once we determined that, then we said, okay, if we're going to go forward and set up a business, now that you've determined to do so, what's the different types of business you can set up? We talked about the incorporation, we talked about sole proprietorship. Then we moved on and we talked about, if we're looking to funding, how do you do the funding next? Then last week we talked to the Minister of Small Business and Red Tape Reduction. How do we therefore expand and move forward? And today we're going to the next level. So every week is comported into modules so an individual can understand not only how to set up a business, different factors to consider, and how to move forward. Additional to BBA also provides information. They're also developing quite a few programs and grant programs to help businesses within our community to actually get up and going. But without further ado, we'll continue to proceed forward. Now, for a slight variation, I'm not sure, we were trying to put a survey. Are we able to put the survey up?
Hi, Anton. You can go ahead to Michael Case.
No problem. So as we have a lot of powered information to go through, we're going to move directly forward and go to our special speaker of today. Our special speaker is a highly accredited Michael Case. He holds an LLM in Masters in Taxation and Laws from Osgood Law School at York University. He owns an MBA, a Master's in Administration from Nova Southeastern University in Florida. He owns a BBA, a Bachelor's in Business Administration in the University of West Indies, and he holds an AIM GT, so AIM GT Industrial Management degree from Institute of Industrial Management in the UK. He's also certified as a CPA, a CGA, and an LPA, and he's done extensive courses in CICA and tax specific courses from the Institute of Chartered Accountants. Michael Case is an income tax consultant with over 25 years in industrial and public sector experiences. The experience consists of audit, review, and compilation of financial statements, finance, Canadian personal, corporate, and payroll tax compliance, and Canadian and United States sales and returns compliance. Additionally, Michael is involved in the audits and appeals for several of his clients with the Canada Revenue Agency, and has successfully defended a Canadian software company, saving them 2.5 million US dollars from the IRS. Ladies and gentlemen, it is my pleasure today to give you Michael Case.
Okay, thank you, Anton, for that
No problem.
Extravagant introduction. Um, I'm humbled to say that I may not reflect most of those qualities. Anyway, thank you nevertheless. Just to add a little bit of background of myself, I was born in Kingston, Jamaica, Jubilee under the clock. Emigrated to Canada some good years back, and when I came to Canada, I came with some knowledge from the University of the West Indies and Florida, etc., and UK, and pursue my CPA. Anyway, I've worked in the field for taxes for some time now, so I may have authority to, give you a practical knowledge of, the old taxation as the same applies to your business. So let me just jump into, the meat of the matter. If I could get my slides up here. So I am going to share my screen.
By the way, I should say, Michael, you're quite with such an academic background. You're quite humble. You might be able to share. I think you can do a little more than share. You have some great, phenomenal experiences. Proud to see individuals such as you in our community.
Oh, thank you, Anton. I'm going to try to share my screen here as to, the progress of, my 1 hour, what I will be talking about.
Okay.
So I don't know if you can see my screen here. Are you seeing my screen?
Yes, it's coming up.
Okay.
Now, for ease of use, what you might want to do is just increase the size of the bottom. Just go to the full slide.
Yes. So is this okay?
Yeah, the button right beside it will go to full slide. That one. No. Go back. One more. No. The other way. One more. The other one. One there. That one. Click that.
Okay, good. Okay, so I'll be talking about taxation as it applies to the different form of structures. And my understanding is that the audience predominantly owned a sole proprietor structure. However, I'll be touching base on all the different type of structures and nuances and what structure should be favored, and also the compliance for each structure. So my next slide, I will be trying to cover all of these topics, the type of structures, the advantages and the disadvantages of each structure, and the personal marginal rate as it applies to individual taxes, and also the incorporated structure and the tax integration with respect to the incorporated structure and the sole proprietor structure, when you should incorporate if needs be, and touch a little bit on GST, HST. And that should take me to, the meat of the presentation, which should be the questions, because the questions would show me your individual, nuances or what you are experiencing in your everyday structure. Okay, having said that, as you all know, there are different type of structures. I highlighted 5 here, which I think would be your major consideration: the sole proprietorship, the general partnership. I'll touch a little bit about limited partnership, but I doubt if most of you here will go into a limited partnership structure, which is a more difficult structure than a general partnership. And incorporation, which is an incorporated business, and a little bit about joint ventures. Okay, what is a sole proprietorship? And it's the opposite of an incorporated structure, meaning that you may have a dream hobby and you decided to, go down to, the ministry and get a master license. That's an incorporated structure. So, sorry, that's a sole proprietorship structure. So with that structure, it's a form of structure, of course. However, the entity and you are that entity, you represent that entity, in the sense that whenever you are doing your taxes, you have to account for all, the income, whatever you do on your personal T1 return by way of that, the T1, 21, 25. So having said that, that type of structure has its advantages and disadvantages. The advantage is that in startup, you can shield a lot of your losses. And if you and your spouse, if your spouse is, say, employed otherwise, this structure can be a benefit in the startup phase because, doing your returns, your T1 returns, you will be, combining, the whole income, and the losses will assist, to get back a large refund from the taxes that he or she would pay at that employment work. Now, the owner has sole responsibility. For instance, if, one of you guys, get a master business license, you have sole responsibility. The risks and the reward, those situations are with you, meaning that you are liable to whatever, nuances or whatever, liability, the entity does or partakes. You are like the business, your friendship with that business, meaning that you walk hand in hand with that business. In the sense, it's not a separate entity. The business is you are the business. So many times a sole proprietorship owner, they will work assiduously in the business without taking any remuneration, without doing anything, and just do minimal record keeping. It may be good and it can work out to be bad, as we will see later down in the slides. As I mentioned, it's the advantages: easy to start up. You can just start up without even getting a business license. Once you declare those income or loss on your your T1 return. In startup, as you know, there are a lot of losses. You can utilize those losses, both couple if you are married. You can, utilize the losses to the benefit of recuperating some of the taxes that, your other half pay. And you are motivated to work. Some of the disadvantages, because the business normally is you are taxed at a marginal rate, meaning that if the business, it depends on the business income. Say, for instance, the business makes, say, for instance, 45,000, you will be at a low tax rate, as opposed to 100K. You'll be going into the different tax brackets. And one of the major disadvantages of this type of structure, the business may not be organized, meaning that the owner may be reluctant in keeping good records and not paying. If they are paying as staff, they may not go through the right payroll, structure with respect to withholding taxes, etc., etc. And there are not much tax planning to be done with such a structure, in the sense that um, most banks, when you go for a loan, they would like to see a structured financial statement approach, in the sense they want to see a notice to read how the business is being run as an incorporated business. But as I mentioned, what type of structure, it depends on the stage of the business. If it's a startup business, or you would like to utilize a year or two losses to get back some taxes, and of course, to test the waters with respect to a business like that. So you would go into a sole proprietorship board. Now, where tax compliance is concerned, the income or loss, as I mentioned earlier, reported on the T1 return. Now, the timing to do that, as you know, if you haven't got a business, you have to report your T1 by April 30th. However, you have a leeway, to do it, June 15th, or, those days, instead of not having a sole proprietorship. Now, as I mentioned earlier, you put that statement of business or professional activities, whatever the nature of the business, on a T2125. So there are some structured within the compliance mode. So even if you don't have any formal record keeping, you may need to, tally up your receipts, how many income, your expenses, and you put it on the various lines on a T2125, and that may suffice, right? So if you are involved in farming activities, you would report those income or loss on a T2042. Those are the different forms embedded in the T1 personal tax return. And if you are in fishing activities, you would do a T2121. I'll stop there. There are different forms, but the T2125, are the major form here for our purpose. Not many of us going into farming activities and fishing activities. Now, the next level is a partnership. And a partnership has similarities to the sole proprietorship. The only difference with the partnership is that all the activities resides at the partnership level. And based on the partnership agreement or contract formed, the income or losses would flow up to the partner. For example, two persons A and B, decided to, let us start a partnership, whether implicit or explicitly, meaning that it can be written out by a lawyer or just by word of mouth. Let's start a partnership. Call it partnership AB. Now, all the activities like your income, the expenses would be accounted for at the partnership level. See, at the end of the day, the income is about $100 and you had agreed on a 50-50. So each partner would get a slip for $50 to go on their personal T1 return. So in effect, it's the same thing with respect to the accountability where tax is concerned. It is reported on your T1 at certain lines when you are doing it. So my simple definition here is stating that when two or more individuals combine to form a business or embark on a joint mission, that's a partnership. And as I mentioned, it's similar to the reporting with respect to the T1. The business is the individual, you know, whenever, that final income, accrues up to the partners. And of course, you have a limited partnership, which means basically you have a general partner and a limited partner. Those structures, those structures are utilized by, corporations. Sometimes they'll say, you know what, where tax planning is concerned, they may have a company here, company A, and they decided, okay, we're gonna have a partnership, where the level of income would go up to the corporation or whatever. So you have different structures, and I've encountered huge structures where just because of planning and moving the taxes all over, you'll have some ULCs up Nova Scotia, and then you'll have some in US. You have a US entity and some Luxembourg, but it depends on our whole. We won't go into that. The tax treaties with different countries and all those stuff. However, at our level, you may find someone say, okay, you know what, let me form a general or a limited partnership, and then we can decide, draft up, the contract. I will be the general partner, the limited partner may be limited to whatever, capital plowing, etc., etc. So most times it's just a general partnership that is formed at our level, meaning that I will take 50%, you take 50, or 75, 25, depending on the level of involvement for each partner. And the advantages and disadvantages, are almost similar to, with respect to the whole liability state. Now, the incorporation, which is a more structured business, in the sense that most times with an incorporated structure, this is not your friend. I normally tell my client, this is your enemy, because the government can throw you in jail, literally, throw you in jail. The government protects this form of entity. Once you incorporate, it's the birth of a person. The Tax Act will state that an incorporated structure is a person, right? It's like somebody coming to being, and the government protects these structure. However, you own, this corporation by means of, the shareholder. You are a shareholder. You may have, you and your wife may decide to be the shareholder. So you may agree on a 50%, structure where common shares is concerned, etc., etc. Now you can incorporate either federally or provincial. Most time people will go online and say, okay, let me incorporate, and they do federal. Now there are some nuances with respect to federal. You have to do your annual, those annual registration, etc., and do some paperwork each year. Where provincial is concerned, you can incorporate in the province of Ontario, and as you know, you can just draft up your structures, your bylaws, etc., etc. Get it stamped. First of all, you have to get a name search to see if someone already possess that name. So the first thing when you decide to incorporate to do a nuance, they call it a nuance name search, because you can't have the same name as a company that is out there, right? A simple structure would be the shareholder and the corporation. Sometimes, after certain years, you can do a lot of tax planning, put in a holding corporation if you decide to do planning later down the road. And what a holding, you can use the holding corporation to, plan and put a trust and all those stuff in. But to keep it simple, I just assume that most of the structure out there is just a shareholder and an entity, meaning that two shareholders or a shareholder control, say, a corporation, Corporation A. And the share structure would be, the voting shares. If you say, okay, 100 shares, or I'll go with 1,000. It depends on the paid up capital. They call it the POC of the shares, meaning that how much each share value. So even if you have 1,000,000 shares and it value half a penny, it's the same, price that will be on the, when you do your notice to read or your financial statement. So it depends on the paid up capital of these shares. And most of the times I have seen when I'm, doing taxes, people would come and say, okay, first time client would come and say, okay, I want my stuff to be done, taxes to be done. And lo and behold, there's no shares. There, how much is the common shares? They may draft up their articles of incorporation, and of course, may not even go into the minutes book to say, okay, these are the type of shares we have. So those are some of the nuances. But if you go to an accomplished lawyer, but you can get that over instantaneously. And normally, I would recommend 100 common shares at $1 per share. And I'll go into, why, or even say $1,000 of shares. But normally, having experience with huge corporations, I have seen corporations with common shares of say 10, 1, and there are reasons, behind that, those you know, those amounts based on a tax planning. So some of the advantages of incorporated structures would be it offers creditor protection. What that means, your personal assets, the shareholder assets are not at risk if anything goes wrong, as opposed to a sole proprietor. If you have a sole proprietor business, and say for instance, no insurance, somebody walking, slipping, the ice, and they can sue you, your house can be gone, etc., etc. With respect to, an incorporated organization or structure, you would have some protection against that. The good one is the capital gains exemption. And what that means is, say for instance, you're getting old like myself, and you say, you know what? I want to get out of this thing. I want to go back to Jamaica, go raft on the Rio Grande, or just sit back. I want to sell my shares of the company. And you have this capital gain exemption. What that means is, say for instance, my company value $1 million, right? And I say, you know what, I'm done with this thing here. I just want to go sit down. If I sell my company, my shares, remember now, there are two types of ways you can sell your incorporated company. You can sell assets or shares. If you sell the assets, No, but if you sell the shares, meaning that you're selling your company, right? The assets and the liabilities, and not just the assets, as in a asset purchase agreement. Say you sell your shares and you sell it for $1 million, right? You have a taxable gain of 883, approximately 883K exempted, meaning that, keep it simple, if you sell it for $1 million, you're exempt 883 of the taxes that you would pay. So say you come down to about 120 something K, and right? So the taxable capital gain is about 60, it's about 50%. So, the capital gain exemption can shield you from taxes when you sell the shares of your company down the road. So you have a good payday. Another advantage is a tax deferral mechanism. As you know, and I will go into the integration strategy later down. Remember, in the sole proprietor, if you make 100K, you may have a marginal tax of, say keep it simple, 45K. You pay $45,000 in taxes, right? Right? Say you earn the same 100K in an incorporated company, right? First of all, you have a thing they call the small business deduction, right? And you are a CCPC, meaning that you're a Canadian controlled private corporation resident in Canada, all those beautiful things. I won't go into that. But you're a CCPC, small, corporation. You are entitled to that 500K of active business, meaning that if you are within those domains, you pay roughly about 12 point something percent. I'll bring up my chart later. So on that 100K, you may pay, say 13% taxes, so it's about what? As opposed to the sole proprietor, 45K, 13, say 13,000. That sounds attractive, right? It's not like that. You pay double, you pay taxes at the corporate level, and whenever you take the money out by way of dividend, you will get taxed again. So what the government does to keep the playing field level, they look at an integration strategy to say, once you pull the money out, the combined taxes that you pay in an incorporated company would be the same as if you didn't incorporate, right? The only benefit of this strategy is if you retain the money in the company and try to invest it down, invest instead of putting it out in dividends. So to get around those tax planning strategies, what you would do is, do a salary dividend mix. A lot of my clients would come to me and say, hey, Michael, you know what? Get that threshold salary dividend to say, give me some salary out of my incorporated business and meet that threshold where it would be beneficial. So those plannings can be effective. Now, as I mentioned earlier, you can be benefited from the small business deduction. Anytime your earnings start to go over your 500,000 K, you start to get into a little bit of the general rate, which is the general rate is a little bit higher than the small business deduction rate. The government intention and purpose is to assist small business with that rate, those small rates. So when your earnings start to go over a certain threshold, you start to go, the income will be taxed differently. And of course, you can do income splitting with your family, but there are some new rules. A lot of owners start, they were manipulating this, so the government come up with those tossy rules. They call it the tax on split income, meaning that your partner, they must be involved in the business. If you pay your kid dividends, people were just abusing the system. So they come up with a lot of GAR rules and rules to prevent those income splitting from materialize. But of course, there are room for income splitting also. Now, some of the disadvantages, when you start an incorporated business, you have to do good bookkeeping. You have to report different revenue stream. If you are taking a dividends, you have to report that on a T5. So that dividend, you have to put it on a T5 at the end of the year. And also you have to do payroll withholding taxes. You know, the government match, you have to match whatever payroll CPP you deduct from your employer, from your employee. So the employer has to match. Say you deduct $10 from, say, a particular employee's earning, you have to match that $10. If you draw EI of $5, you have to do 1.4 of that EI that you draw. Those are withholding. And of course, take the taxes from the individual and, you know, do a nice little reporting package and report that the next 10th of the month, say February withholding would be, you know, withheld in February and report to the government in March, by March 10th. So you have all those nuances to do. So you have to pay to get those done. Also, GST, HST filings, of course, you will be over that threshold. I'll touch a little bit on GST, HST. You know, once you're over 30K, and it makes sense with an incorporated company to just register for all the different program accounts at day one, once you incorporate, right? Another disadvantage is the inability to claim loss at the personal level. These losses, they must reside inside the company, and you can use it in good time to shield your revenue. Say, for instance, the business would make, say, 100K loss this year. You know, you have forward-looking, you know, years to claim those losses against your revenue, but you can't use it individually as a shareholder, you know. So those are the major disadvantages. Now, this slide shows, sorry.
Quick second for you right now. I'm loving where you're going, but I want to make sure we're leaving enough room for there's a lot of questions coming up. So if we can expedite that process so we can have a room for
Sure.
To ask.
So this slide shows a little bit of the different rates in effect for the personal, you know, the personal tax rates. And as you know, my slides are in the way here. As you know, there are different rates for the dividends, eligible dividends, and ineligible dividends. Eligible dividends meaning that it may be taxed at the general corporate rate as opposed to the ineligible dividends at the different rates. So if you notice here, the rates differ. These are your marginal rates with the different income here. And you have some credits when you do your personal taxes. You have your basic personal federal tax credits and your provincial. These are all embedded in your returns to give you, some credits to give you back your taxes if you are employed somewhere. Now, you remember, I should touch base on this one. You remember I was talking about that integration factor. Say, for instance, you have a 100K of revenue inside a corporation. You are taxed at, say, 12.2%. So the corporate tax payable, that's level one, would be $12,200. If you retain this $87,800 in the corporation, okay, you may get away. What if you take it out? This is where you start to get taxed to bring it back to if you were earning this inside a sole proprietor. So you look at the total after-tax income, it's 45,884. Look at down the bottom, probably my slide here. So you are better off 586, not much difference. So the integration factor work to, to equalize when you start to take the money from the company. If you retain it in and invest this amount in, say, a 1% or 2% investment vehicle, you will have some money down the road. Now, as you all know, registration, you don't need to register if you're a small supplier, you have a less than 30K, right? You don't need to, register. However, if you start to go over 30K without registration, they'll force you to register. I'll just keep it short there. And a lot of times, tax planning with respect to, you build that sole proprietor. Then when you incorporate, if you're a trade person, you throw all the tools over, you throw all your cars over to the incorporated company. That is like giving away your years of working, to build that sole proprietor to assume an incorporated state. It will be best you do some tax planning, do a Section 85, take back some shares, and most of the times a Section 85, they call it a Section 85 rollover, to move your assets from your sole proprietor to your incorporated business can make sense. Some of the times it may not even worth it, but it depends on the level of analysis. And I will go into the major part to hear your questions and try to put some answers towards your questions.
Absolutely. Mike, I thank you so much for that. There is, you definitely provide us a wealth of information that we want to share. But let me go right into it. But before we do, I know there were some questions asking, those were asking, do you have any insight on the not-for-profit realm as well?
Anton, before you move ahead, Michael, could you bring down your screen share for us, please?
My screen share.
Yes, could you end your screen share?
Okay. Okay.
Thank you so much.
Perfect. Can you talk to us a little bit about the factors that's leading to the not-for-profit? There's some of the attendees that they're from the not-for-profit realm and want to get some understanding of the implications of setting up a not-for-profit.
Well, as you know the name, not-for-profit. A not-for-profit means that when you start a not-for-profit, it's an intention to do some service without, garnering and not a profit base down the bottom. So a not-for-profit structure differs from a incorporated structure in the sense you go into an incorporated structure with a view to making profit for your shareholders or whatever. A not-for-profit, you have to be careful not to lose your not-for-profit. And also, if you go to the next level, which is a charitable status, you start to see a lot of scrutiny with respect to the government. You may need to have a review, at least a review done. If you are getting funding, you may need to have at least a review to get additional grants or government funding, etc. Now, from a tax perspective, it depends, how you're operating with respect to the not-for-profit. But generally, a not-for-profit files an informational return at the end of the day to declare, the different areas on that informational return. So as I mentioned, it's a different structure than an incorporated structure. You have to be careful with respect to, the legislation because it's been heavily policed, recently. And you have to conform to certain not-for-profit depending on the level of revenue that you have. Say if you're running under a certain threshold of, grants or whatever, you can just do a straight, notice to reader. However, if you start to go over, you may need to segregate the different program accounts where you get the different fundings and, set up your financial statement in such a way as to, facilitate those type of structure.
All right. In the interest of expediency, I'm going to swing over. There was a question: was are churches and colleges not-for-profit organizations? Very high level.
The what? Sorry.
Davon wanted to know: are churches and colleges not-for-profit organizations? Are they just limited to, because I know there's some changes? Are they still considered, or are there additional requirements? Very high level.
Well, to go into the colleges, it's mandate, the Ministry of University and Colleges. These guys are the quote unquote the police for those universities and colleges. So you will have to, adhere to their legislation. With respect to churches, most churches, they not most, almost all, they are not for profit entities. And if they register for where charity is concerned, they can be, those donation receipts and all those stuff, they can give a receipt at the end of the year for those. So to answer your question, churches, not for profit or charitable status. The colleges, it depends, it depends on, what is the intention or the formation purpose. However, the Ministry of, Training and, those NTUC, they control, those laws and legislation.
Perfect.
Anton,
Let me start to hit him with.
Anton?
Oh, I'm so sorry. Was that Michael?
Yeah, sorry. I just wanted to interject by saying that the Income Tax Act 149, Section 149 stipulates non-profit. So once we use that term, it means that they're not going to pay taxes. Okay. But as Michael explained, if they do not work within the rules, if they start to do things that look taxable, then they can lose that status and they'll be taxed.
Perfect.
And most churches and municipalities and places like that automatically fall under the non-profit regime.
And that's a good point that Michael, brought up. Whenever you are doing, remember I told you about an informational return. And before you start to embark on a not-for-profit information return, there's a part on the jacket that says, do you fall within the range of the Section 149? And you have different charitable stuff, etc. Once you tick those boxes, it moves you to the next phase. And that's correct. And, not-for-profit may or can lose their status if they are not, adhering to, the legislative or the purpose or the intent of, when they incorporate.
I'm trying to cut you short there, Michael, but we have some great questions coming up, and we only have a limited amount of time first. First, I want to go to, there was a question that came up. Where online can someone find out some of these, let me see if I get the question correctly. Where online can they find information on different tax write-offs? Is there a particular location they know they can go to?
And that, you mean with respect to incorporated taxes? Yeah, you can go to the T2 informational guide. However, those are CRA secondary publications. They'll give you an hint of what you can write off. However, your accountant, will be able to walk you through, different strategies or tax planning. A good example is mileage. Most people don't know, they can claim 54 cents per kilometer or something to that effect. Then conventions. Michael, it's about 2 or 3 conventions you can attend per year. Michael Pinnock, can you confirm that you can go and think about it?
It's okay, Michael. There's a lot of stuff available.
Yeah. I don't want you to go into too much detail because we have a lot of questions I want to be able to hit and cover.
But to answer your question, you can do, a lot of write-offs limited to the Income Tax Act.
If you generated to earn location that they can go and find it. Is there a website that you know offhand?
Well, you can go on the Canada Revenue Agency website and go to, doing your T2 tax corporation taxes. So you can just go online and get that information. But as I mentioned, there may be limited information there. So you can go into your, the Justice Canada website and go to certain sections of the Income Tax Act.
Well, I don't want to go too much detail because we only have 9 minutes left. So can you discuss some of the criteria that must be met in order to be qualified for a small business corporation when selling one's business?
I'll repeat that question.
Can you discuss some of the criteria that must be met in order to be a qualifying small business corporation when selling one's business?
And that's a good question. Those are like technicalities you're going into now. So it must be qualified small business shares. So, you have to do some analysis with respect to the whole of your financial statement to make sure that there are no impurities, and you have to make sure that you qualify for those stuff. To go into that will demand a lot of time, but to answer your question, it must be a qualified small business corporation share so to get to that level.
All right. Quick question. As I said, we only have a short amount of questions yet. Given there's a lot of people actually going for some of these loans and setting up some of these loans, many didn't qualify. What were some of the predominant reasons why many organizations did not qualify for some of these loans?
As I mentioned, from a loan perspective, we have a lot of loans out there from the individual level to the entity level. One of the major one is that 60K, 40K first, and then they increase it to 60. So you have to look at the intention why the government puts out those grants. That loan, which is the huge one for 40K, the intention was to retain, retain the employees, not to lay off the employees, in such a crucial time. So the government comes out and it was pegged towards a payroll. You have to have a threshold payroll level to qualify. Now, there were a lot of hullabaloo later down to say, oh, we need to help and give more assistance to small business. So the government kind of tweak it and say, okay, if you have qualifying expenses, so option one was the payroll route. Then option two, if you have qualifying expenses over certain, I think it was about 40K, and you have proof of those expenses, we'll give you the loan. And they up it to another 20K, and you are forgiven. If you take 60, you are forgiven 20. There's another one they call the SUS, heavily geared towards a payroll situation, to retain the payroll. So you have to look at the old intention of those grants. There are 20K grants to assist, with respect to if your entity doing a lot of PPA protective stuff. You have to look at the intention of the loan before, you can jump into, such a loan. But most of them geared towards the retention of the employees that you have on. And, to qualify, you may have to compare your revenue level to a certain time. They call it the qualifying benchmark. If you look at a year-over-year comparison.
Let's go down to a quick second. We're going into a little too much detail, and I said we only have at this point 6 minutes left. So, in order for, is something that business can actually do that were disqualified before? What are the key requirements? So, one is, for example, do they need a payroll? They need a payroll system. Is it that they need revenue? Is it they need a business account? What are the things that they need to qualify for? The BBVA is working with some programs right now to help businesses that are insufficient, but they at least need to know why they were disqualified and can they reapply?
Yes, they can reapply, because I have done a lot of those applications, and most times it's not as a result of not proving your expenses. The system were blocking a lot of those applications. So now there's a system that says, hey, reapply and we look at it again. So if you know you have qualifying expenses over 40K, you can go for that 40K loan again, but you have to be organized to show your receipts. If you have payroll, the payroll is reduced to about 20 something K, in that region. So if they remove it from that high amount, so if your payroll is in that range, you can reapply and it should go through. And you can apply for the whole 60 this time with a 20K forgiven amount.
Perfect. There was a question that was raised by Ima and Ima Eason. And so where do social enterprises fall in this schema? Because social enterprises intentionally do things that start to look taxable. where do they fall with regards to taxation?
Social enterprise, what type of structure? Is it a not-for-profit? It sounds like a not-for-profit to me when you say social enterprise.
Hi, I'm here if you'd like
Yeah,
me to answer. I'm not
yeah.
sure what's up with my video, but um, social enterprise. So yeah, we're looking at a nonprofit structure, but of course the idea is to make enough money that you're not totally dependent on grants. We're also looking at employing some youth in the area. So that sort of turns it into an employment social enterprise. But I've been looking a lot at these forms or these structures, and I can't see a place where it falls into clearly.
It sounds to me like it's fall under, once it falls under that not-for-profit structure, that's a legislative intent. I have formed some social um, entities, and if it's not incorporated to get a profit, it's a social, a not-for-profit. So to answer your question, it may have fallen in that domain, but we can talk if you want to just give me more information on that type of structure, and I could do some additional research what you're talking about.
Oh, sure. That's great. Thank you. I'll get your contact, I suppose, from the BBPA.
I'll be following that out shortly. Thank you so much for
Okay.
that. Unfortunately, we have run out of time today. Michael, would it be okay to share your contact information with the people? So if you have some more direct questions, you can get from him, and I'll share it to them right now. Michael Case, MAC Professional Corporations. His email is macprofessionalcorporation@gmail.com and or taxcase@rogers.com. Michael, unfortunately, we ran out of time. Was there any last things you would like to illuminate to our audience before we transition off?
Okay, just one last word. Whatever structure you have in place, once you are organized, you can get all the benefits. And just go to incorporation just for incorporation's sake may not be even the right structure. So it depends on your situation, and you have to just talk to your professional, your accountant, and your tax accountant or practitioner to know if what type of structure pertains to your particular type of situation. And if you need any advice, you can reach out to me. I will try answer as much email, limited to time, with respect to your type of structure.
Michael, I thank you so much for your information. You definitely provide a wealth of information. We'd have loved to get you for another 20 minutes or so to ask you some additional questions, but we may have to bring you back at a future point. To everybody else, I'd like to thank our sponsors, RBC, HSBC, Donald Reed Estate, and ask that you please note that they continue to sponsors going forward. The BBPA is here to support us and the community. And this is part of the Level Up program, which takes them from cradle to grave, how to set up an organization, how to factor the businesses, how to structure, how to get funding. We're going right through. So for all those in the audience that are looking to set up businesses, please continue to stay with us. It's a part of a 13-week program. Today was the 5th of 13. Going forward, next week, we will be focusing on same time, same place, next Tuesday at 2 o'clock, putting your best case forward, how to beat the business loan application process. For follow up, we'll be doing additional programs as well. Next Tuesday evening, as well as this Tuesday evening, is the BOSS program, BOSS Women's Program, put on together at 6 o'clock. Tomorrow, we'll be followed for the Ask the Professional series, which is welcoming the newest members to the BBPA community. And each and every Saturday, we have a community space at 10 a.m. providing financial literacy to youth and young adults for high school and university students. And upcoming in April, we have the Harry Jerome Awards. Again, for those that's been following for quite some time, we've seen this is where we showcase the best in our industry. And we're at this time taking nominations. Please go to the site BBPA. Also, this and other shows will be also recorded and posted on the BBPA site. Again, we're here to help you. We're here to support you. We're here to go through. The BBPA is here for you. I thank you so much for coming out today, and I look forward to see you next week. Be safe and stay safe.
Thank you.
Michael, thank you very much for your information. It was, unfortunately, we ran out of time, but you definitely provide some great information and feedback.
Mr. Case,
Michael Pinnock, how are you doing, sir?
I thought you'd have gone straight into the taxes because the week before we had a lawyer talking about those stuff.
The taxes?
Yeah, I thought you'd have gone straight into the
Hi,
taxes
Michael.
because
Would it be possible for us to wait until we're off? For
yeah,
my
why
apologies on
can't we
that.
just bounce them off when anything finished, Tanisha?
We can, but they're still on. We're scheduled to cut them at 3:03.
But why is 3:03? The program finished at 3.
I'd be happy to discuss it with you right after.
And it's okay, I hear it, Tanisha. But I'm not
I'm
used
going
to
to put you in a
that
breakout
stuff.
room with Michael, okay?
Yeah.
Again, thank you for everyone that came out today. We seek to continue to support you as we're going forward. Please stay tuned. Again, as a recap, the first few weeks we talked about looking at the landscape of our economy. Then we talked about setting up a business. Then we talked about how to position the business for funding. And today we started to talk about taxable implications. We'll continue going forward as we march from end to end, setting up, running a business successfully in this community. Further, please look to BBPH. You'll find additional resources and grants and programs that they're not just providing information, but they're providing funding and resources to help all those businesses. So please, for all those looking, go to the bbpa.org and you will find additional information to see how the Black Business Professional Association is not only helping in this time, but helping to transition you to higher levels. Thank you all. And again, we appreciate you coming and support, and we look forward to seeing you next week.